Hello, everyone. Welcome to Grava Adventure Corporation. My name is Aaron, the founder and CEO of gograva.com. Today, we're going to be talking a little bit about starting a business in 2023 with a looming recession. We see it a lot on YouTube, a mix of information that you're seeing on the regular news channels and things like that. But as I'm starting a business and as I've been following the markets since probably the dot-com bubble, before the dot-com bubble, I find what we're being fed, or at least what we're seeing online or people are talking about, isn't necessarily what's going to happen. And in some instances, it's actually going to be a recession. I don't know how we don't have a recession coming up. So what do I think as a recession is coming? What am I looking at? How are my loan rates in starting this business? What challenges have I seen? And am I worried about the future of my business or my business idea as we head into a recession? So let me get into this. And I'm going to add this to our stream here. And starting a business in 2023, looking down the barrel of a recession. You know, it's really quite scary, I guess, but you know, it is what it is. So I use like the hope indices. So I'm going to be using some of the media files produced by other people. None of this is my work that I'm about to show here. But Michael Kantrowitz, I think is his name, Michael Kantro on Twitter. You can follow him, but he really nails it with what's called the hope index. And I'm hoping my slides show up well here, but oh, they do. So the hope index really is what the roadmap of the economy as it responds to changing interest rates, especially the Fed funds rate. So usually what Michael says, the first to slow is housing. That's housing starts and housing prices. Then new orders for manufacturing slows. You see a decline in profits from company. And then the last part to fall is actually employment. And so let's take a look at the hope index here real quick. And I'm going to go through this quickly, and I'll go through each one of these, but historically speaking, or looking back over the past 2 years, you know, housing starts kind of peaked early after COVID. Prices started to increase, and then now we're starting to see prices, generally speaking, for the housing market decline. Now, in some areas, this doesn't apply, but like in Phoenix, there's declines, LA, Boise, other areas like that. My market in Pennsylvania, central, you know, near Philadelphia, it's not really declining yet, but it's starting to turn. So we're starting to see housing is turning. And we've also seen a decrease in manufacturing orders over this past year. Now that's maybe due to oversupply because we were so low, but overall, you know, manufacturing orders and orders are slowing. Same thing with profits, even though we see 6 companies probably holding up the stock market right now. Generally, profits have been on the decline. Now, estimates, you'll see on Bloomberg, they talk about, oh, they hit their estimates, but there's a lot of manipulation going on with stock buyback programs and stuff like that I won't get into. And then employment is the last thing to fall, or unemployment is the last thing to increase here in our chart. So building permits versus the home construction ETF, the ITB. And as you can see, the iShares ETF, the orange line there, which is your home builders or home construction ETF traded fund, is still on the rise, even though building permits are starting to plummet. And they keep going down because as demand wanes, really it's just a function of interest rates, right? The 10-year bond yield is up, which means mortgage rates are going to be sitting at 7%. So the cost of money is getting more expensive and people can't afford these higher houses. I'm already seeing it in our neighborhood where housing prices or houses that's selling are under the $300,000 limit. And those are selling pretty quickly. And then home prices as a percentage of change recently, according to Redfin, you know, we're now gone below the 0% mark. We're at negative 4.1% housing price changes. So housing prices are starting to roll over. And really that red line, I believe anytime you peak, it's almost like a sine wave. You're going to come back down in relation to that too. So there's going to be a correction in these prices. So next up is we look at, orders, profit margins, and really the most important chart here, what you really got to pay attention to with the stock market is there's like 6 companies: Google, Microsoft, Nvidia, to name a few, Apple, are just really holding up the economy right now. And it's only because people are taking their money out of these smaller companies and depositing it into these bigger companies for safety. So it's almost like a safety move. And what we're looking at here with this chart is the difference between your small cap, your smaller businesses, their stock price versus the NASDAQ 100. And you can see we are at back to .com bubble levels, where technology stocks are really outperforming just your standard businesses in the economy by, what is that, a factor of 8 right there, which is tremendous. And when you get up too high, bad things happen. It's got to not, but it's just got to balance. The market's all about balancing itself. And we got to the last part. We look at the home in the Hope Index. The E is employment. Now, without doubt, back to 65 here in this chart, the bear market what always precedes the bear market is super low employment rates or unemployment rates. Super high employment rates, super low unemployment rates. And we are now beginning to turn up with unemployment, which is the last straw here for the economy. So I am perceiving with my business that it's going to hit us probably in October. There's a lot of things coming in. Student loan repayments will be started up by then. I think we're going to see more of this earnings coming in, lower than expected with companies. We'll be through a summer where housing prices would have been declining and interest rates are staying high. I don't think the Federal Reserve is going to be dropping interest rates anytime soon. They need to cool down this inflation. Inflation's got to get under control. And so it's coming. It's almost here. And then the bond market's also screaming. We have a chart here, and the primary thing we're going to look at, and this goes back to 74, is the difference between the 1-year bond and the 10-year bond. And what we're looking at here is normally in the bond market, like the federal fund rate is about 5.25% right now. Now, normally, let's say a 3-year treasury, you buy a 3-year treasury, you'd expect that 3-year treasury interest rate to be lower than the 30-year treasury interest rate because you're investing your money for a lot longer. But we see the exact opposite going on right now, where the 1-year treasury is paying out much more than the 10-year treasury. And so what we get is this inverted yield curve. Now, I usually like looking at it the other way, where we see the negative as the inversion, but it's the opposite way here. But we have a humongous gap between the 1-year and 10-year treasury, where the 1-year is paying out much more than our 10-year treasury curve, about 1.5%. Always precedes a major recession. And the scary thing is that this inversion is higher than it's been since roughly, 1980. This is landmark stuff here. Same thing. Another chart, we're now looking at the 3-month to 10-year treasury yield curve. So where we have a negative correlation, which is bad for the economy, you see that in red. And we are deeper in the negative here between the 3-month and the 10-year than we have been, again, since 1980. I mean, this is really big. So I don't see how people think we're going to get out of this, these problems we have, this overspending that we did, throwing this slush money around in the economy the last couple of years without a major recession. So what have I experienced? So what I've experienced is normal, I think, for this kind of economy. At Grava, lending is tight. Money is really expensive right now. But there's an advantage, because as I'm starting to see weakness in the economy, I am also purchasing at, wholesale products at 25% discounts in certain areas. And those discounts, as we go into a recession, are going to get deeper and deeper and deeper. So even though my money's more expensive, I am starting to get things at a discount. My experience with loans has just been all over the place. Like my first loan that I got for a piece of equipment was on a 6% interest rate, which is really good. That's really good. The only thing the manufacturer wanted to do is they wanted to front load or put that 6% interest rate into the actual amount of the loan and then charge 0% over 48 months, which I said, sir, no problem. Because they thought I'd be successful and they were worried that I would just pay the loan off quicker. And they wanted to capture all that interest money over 48 months. So instead of having an early payoff penalty, that they just threw it in there at 6%. So that was not bad. The second loan I got was at a 13% interest rate, and that's about normal right now. Like for a new business starting, it's going to be anywhere from 12 to 16% interest rate to touch money. That's expensive, man. It's so expensive. And then to use or leverage credit cards, you're looking at 20 to 21%. I mean, the best thing I can do there is just get an airline credit card for my business and at least try to recapture my expenditures and turn those interest rates into free airline flights and free hotel rooms when I do the business travel that I have to do. That's the only way I could justify it. And there's actually been worse loan offers. I had one loan offer. Oh, geez. Let me talk about the worst case. So I had one loan offer at 28% over 2 years. Then I used a company that said they could get me access to like hundreds of thousands of dollars. No problem, piece of cake. They do this all the time. All they do is charge 15% of the total loan amount. So if I got a $100,000 loan, they charge 15%, and I'm still stuck with the interest rate I get from the bank. Well, they couldn't do it. They learned quickly also that when I was looking for money back in March and April of this year, that it is pretty much shutting down for new businesses. Access to capital, access to credit is really, really difficult. So, am I worried? I mean, yes and no. I mean, starting a business, you always have some worries and stuff, but, am I not going to start a business? No, am I okay with risk? Yes, I'm okay with risk. I'm a kind of guy, it's okay with risk. My company is a discretionary spending category. So if we go into a major recession, yes, people are going to cut back on their spending. No, they may not buy any of my stuff. But I still believe in the abundant money theory that there's just so many trillions and trillions of dollars of money out there that I can get some people to spend some money and actually help them along the way through this recession process by showing people how to go outside and take a walk in the park, how to go camping, how to ride a bike, how to save money through commuting on a bicycle, how to go to the grocery store and buy your groceries. Like there's things that our company, Grava Adventure, is going to do that I also believe is helpful. And when recession comes, not everybody loses their job. Not everybody's out of work. You may see in some areas like California, 10 to 12% unemployment rate, Phoenix, high unemployment rate. But other areas, you will get up to 6%, probably 7%. But as a new business, I do have some advantages. My overhead costs are nearly non-existent compared to an established business. I am literally using my brother's garage in Wyoming to do fulfillment and do some t-shirt printing and embroidery services. And we are renting out a storage facility at $175 a month. I don't have a building. I don't have a lot of employee costs. We have flexibility with our manufacturing, and we have solid partners in South America who are also starting their own businesses. So they have flexibility. They won't have to lay people off, is what I'm saying. So I've been looking for people who are new startups in South America and Central America who want to start a business through this recession that we're going to have and come out of it even stronger with a solid, balance sheet, solid business plan that's been proven in the depths of fire in a recession. So the other thing I got to lean back on is Grava Adventure Corporation is a team of 4 people, a team of very determined people who are going to overcome the obstacles as we see them. We're going to find ways to make money. We're going to find ways to work with our manufacturers to make some money. We're going to find ways to do things. And, like YouTube video here is just one of those programs. We're going to overcome any obstacle that's coming at us because we can do anything. Money's abundant. We can do anything. So with that said, everybody, wanted to, before we open our store, so gograva.com will be open June 8th for sales, ready to go. And before I open my store, I'm going to spend every day talking about the beginning of my business journey before we actually get into how to have an adventure, how to clear your head, working from home, all these things, how to ride a bike, how to go bikepacking, how to spend time with your kids while you're outside, all these fun things that we need to do when times are tough, that we need to take a break when times are tough. So stay tuned for more information. I have a whole schedule this week of videos I'll be putting out. Please like and subscribe. My new channel, nobody's going to watch this for the first couple of months, so I really can just do whatever I want, I feel like. So thanks again. If you do happen to watch it, please leave a comment and follow us along social media. Check out gograva.com. Thanks, everybody. Bye.